What if I told you that for the past 4 years straight, the world has consumed more silver than it's produced? Not by a little, but by hundreds of millions of ounces. We're talking about a combined deficit from 2021 through 2024 that equals 10 months of the entire planet's mine supply. And here's the kicker. This isn't a temporary blip. The structural forces driving this imbalance are only getting stronger. Today, we're diving deep into silver's supply crisis and why it's not going away anytime soon. Welcome back to the channel. Before we begin, a quick disclaimer. This video is for educational purposes only and is not financial advice. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Now let's understand what we're really talking about when we say market deficit. In commodity markets, a deficit occurs when total demand for a material exceeds the total available supply during a specific period. Think of it like a bathtub. If more water is flowing out than flowing in, the level drops. For silver, supply includes newly mined production, recycled material, and any government or industry stocks being sold. Demand encompasses industrial fabrication, jewelry, silverware, coins, bars, and investment products. When markets run deficits, they draw down existing above-ground inventories, the stockpiles held by refiners, dealers, exchanges, and investors. A deficit for 1 year might not be concerning. But sustained, multi-year deficits, that indicates a fundamental structural imbalance. And that's exactly what's happening with silver. According to the Silver Institute's World Silver Survey 2025, released in April 2025, the silver market has now been in deficit for 4 consecutive years from 2021 through 2024. The combined deficit over this period reached 678 million ounces, equivalent to 10 full months of global mine supply in 2024. Let me repeat that. The world has consumed nearly a year's worth of production, more than it produced over just 4 years. Let's break down the numbers year by year. In 2024 specifically, global silver demand totaled 1.16 billion ounces, according to the Silver Institute. Meanwhile, total supply, which includes mine production of 819.7 million ounces, plus recycling of 193.9 million ounces, came to just over 1 billion ounces. That left a structural market deficit of 148.9 million ounces for 2024 alone. This marks the 4th consecutive year of deficit conditions. While 2024's deficit was slightly smaller than some prior years, partly due to a 22% decline in physical investment demand for coins and bars, the deficit persists because industrial demand continues hitting record highs year after year. Here's what makes this particularly significant. These aren't small marginal deficits. We're talking about demand outstripping supply by roughly 10-15% annually in recent years. The U.S. Geological Survey confirms that global consumption in 2024 was approximately 37,000 metric tons, while production remained around 25,000 to 26,000 tons from mines plus recycled material. The question everyone should be asking is why? What's driving this sustained imbalance? The single biggest factor behind silver's deficit is industrial demand, which hit a record 680.5 million ounces in 2024, the 4th consecutive record year, according to the Silver Institute. Industrial applications now represent approximately 59% of total global demand, up dramatically from historical levels. Let's break down the key industrial sectors. This is the heavyweight champion of silver demand growth. In 2014, solar panels consumed just 11% of industrial silver. By 2024, that figure reached 29%, nearly 1/3 of all industrial demand. According to the Silver Institute, solar PV demand has more than doubled in the past decade, driven by global renewable energy targets and falling solar installation costs. Each solar panel uses silver paste in its photovoltaic cells to conduct electricity. Despite ongoing efforts to reduce silver loadings per panel through thrifting techniques, total demand continues growing because solar installation rates are accelerating faster than thrifting can compensate. The Silver Institute noted that while notable advancements within the PV segment led to a sharp reduction in silver loadings, overall PV demand still remains at historically elevated levels. Silver's unmatched electrical conductivity makes it indispensable in electronics and electrical applications. In 2024, the electronics and electrical sector recorded record demand, supported by growth in electric vehicle production, consumer electronics, and, importantly, applications related to artificial intelligence infrastructure. The Silver Institute specifically highlighted that demand received a boost from AI-related applications, which drove growth in consumer electronics shipments. As data centers expand to support AI computing and electric vehicle adoption accelerates globally, silver demand in these sectors continues its structural upward trend. Beyond solar and electronics, silver is critical in brazing alloys, up 3% in 2024, ethylene oxide catalysts used in plastics production, water purification systems, antimicrobial applications in medical settings, and various specialized chemical processes. The other industrial category grew 4% in 2024, according to the Silver Institute. What's crucial to understand here is that these aren't cyclical demands that will decline in a recession. They're structural, long-term trends tied to global electrification, decarbonization, and technological advancement. As the Silver Institute notes, these represent structural gains linked to the green economy. Now let's flip to the supply side, where the problem gets even more interesting. If demand is surging, why isn't supply keeping pace? In 2024, global silver mine production increased by just 0.9%, less than 1%, to 819.7 million ounces, according to the Silver Institute. That's an extremely modest increase given the sustained deficits we've been discussing. The U.S. Geological Survey reported that U.S. production rose about 6% to 2,100 tons in 2024, but global output growth remains sluggish. Here's a critical fact that explains why. Approximately 72% of global silver mine supply comes as a byproduct of mining other metals, primarily lead zinc operations, followed by copper and gold mines. Only about 28% comes from primary silver mines. This means silver production is largely price inelastic, as the World Silver Survey notes. Even if silver prices rise significantly, most mining companies aren't digging specifically for silver. They're mining zinc, lead, copper, or gold, and silver just comes along for the ride. According to the Silver Institute, silver production from lead-zinc mines remained the dominant source of silver, but output was flat year over year. Meanwhile, production from gold mines showed the strongest growth at 12% year over year, but this represented just 13.9 million ounces, a small portion of total supply. In 2024, the top silver-producing countries remain Mexico, China, Peru, Bolivia, and Chile. However, production challenges persist. Chile's output fell by 8.8 million ounces year over year. Mexico's production recovered as Newmont's Peñasquito mine returned to full production after previous disruptions. But this highlights the vulnerability of supply to operational issues at a handful of large operations. Silver recycling did provide some relief in 2024, rising 6% to reach a 12-year high of 193.9 million ounces. This increase was driven primarily by processing of spent ethylene oxide catalysts and increased silverware recycling as higher prices encouraged selling in Western markets. However, recycling still represents only about 19% of apparent consumption in the United States, according to the USGS, and roughly similar proportions globally. While recycling has grown, it cannot close the gap left by insufficient mine supply growth. Physical investment demand, coins, bars, and allocated silver products, represents the most volatile component of the demand equation. In 2024, coin and bar demand fell 22% to 190.9 million ounces, a 5-year low, according to the Silver Institute. This decline was particularly sharp in Western markets. U.S. demand dropped 46% due to profit-taking at higher prices, market saturation, and shifts in investor sentiment. Germany continued experiencing weakness from lingering effects of a 2023 VAT increase on certain silver products. However, India stood out with a 21% surge in physical investment, driven by bullish price expectations and an import duty cut. Here's what's fascinating. Even with this significant decline in investment demand, which dropped by roughly 50-60 million ounces, the market still remained in deficit by nearly 149 million ounces. This tells us that the structural deficit is being driven primarily by industrial demand, not investment speculation. If investment demand were to rebound to historical averages in response to economic uncertainty, currency concerns, or inflation fears, the deficit could widen substantially. Several broader factors influence silver's supply-demand dynamics, though we must be careful not to engage in speculation here. The World Silver Survey 2025 specifically identifies U.S. tariff policies as a key risk factor for 2025. The report states, an extended period of elevated tariffs, or a further escalation of global trade wars, could lead to significant supply chain disruptions and sharply lower global GDP growth. These would negatively impact industrial, jewelry, and silverware demand, though potentially benefit physical investment demand through safe haven buying. Government policies worldwide supporting renewable energy adoption directly impact silver demand. Solar installation targets in major economies, China, the United States, Europe, India, create policy-driven demand floors. Any acceleration or deceleration of these policies materially affects silver demand trajectories. Silver's role in critical technologies, from electronics to solar to EVs, means supply security is increasingly viewed through a strategic lens by governments. However, unlike some critical minerals, silver production is geographically dispersed across multiple continents, reducing single-country supply concentration risks. So what does all this mean for the silver market going forward? Let's focus on structure, not price speculation. 4 consecutive years of deficits totaling 678 million ounces means above-ground inventories have declined substantially. Exchange-traded product holdings, dealer inventories, and other visible stockpiles have been drawn down. While comprehensive global inventory data is difficult to obtain, the COMEX Exchange in New York reported inventories of approximately 9,520 metric tons at year-end 2024, according to USGS data. Continued deficits would further erode these buffers, potentially leading to periodic tightness in physical markets, particularly during demand surges. The Silver Institute's outlook for 2025 projects mine production will increase by only about 1.5%, resulting in an expected deficit of 117.6 million ounces, smaller than 2024 but still marking a 5th consecutive deficit year. Given that 72% of silver comes as a byproduct, meaningful supply increases require either higher base metal prices, incentivizing more lead, zinc, copper mining, or significant new discoveries and development of primary silver deposits, a process that typically takes 7 to 10 years from discovery to production. The silver industry continues working on reducing per-unit silver usage. Solar panel manufacturers have made notable advancements in reducing silver loadings per panel, according to the Silver Institute. However, thrifting and substitution remained limited across most sectors. This suggests that while some efficiency gains are achievable, silver's unique properties, especially its electrical conductivity and reflectivity, make substitution difficult in many applications. How do markets typically respond to sustained deficits? 3 mechanisms: price adjustment to ration demand, increased recycling incentivized by higher prices, and enhanced mine production where economically viable. We've seen modest movements in all 3 areas, but the fundamental supply-demand imbalance persists. Let's bring this all together. Silver has been in structural deficit for 4 consecutive years from 2021 through 2024, with combined deficits reaching 678 million ounces, equivalent to 10 months of global mine supply. This isn't a temporary phenomenon driven by speculation or short-term disruptions. The deficit is fundamentally driven by record industrial demand, particularly from solar photovoltaics, electronics, electric vehicles, and AI-related applications. These are long-term structural trends tied to global electrification and the energy transition. Meanwhile, supply growth remains constrained because 72% of silver production comes as a byproduct of other metals, making it largely price inelastic. The Silver Institute projects 2025 will see a 5th consecutive deficit year, though smaller at 117.6 million ounces. Investment demand remains a wild card. Its 2024 decline actually prevented the deficit from being even larger, but any rebound could significantly widen the gap. What's clear is that silver's supply crisis stems from fundamental structural forces in the global economy. The intersection of renewable energy adoption, vehicle electrification, electronics proliferation, and constrained mining output creates conditions unlikely to resolve quickly. As always, this analysis is for educational purposes. Market dynamics are complex, and numerous factors we haven't covered could influence future outcomes. What's your take? Do you think supply will eventually catch up with demand, or are we entering a prolonged period of structural tightness? Drop your thoughts in the comments. I read everyone. If you found this analysis valuable, hit that like button and subscribe for more data-driven commodity market breakdowns. Thanks for watching, and I'll see you in the next video.